Imagine this scenario. You wake up, open your banking app or brokerage account, and realize that your wealth seems to have shrunk overnight. You didn't buy anything new. You didn't sell anything. You didn't make a single transaction. And yet, your net worth looks dramatically different. Scary, isn't it? This phenomenon has a name, and it moves billions of dollars every single day on Wall Street. It is called mark-to-market. For many beginners, this concept looks like a boring accounting rule, but in reality, it is one of the most powerful and dangerous forces in the financial system. And here's the fascinating part. If you understand how mark-to-market works, you can transform the fear of others into opportunity. Today, I'll show you exactly how you can use this dynamic to your advantage. Let's keep it simple. Mark-to-market means revaluing your assets based on their current market price, not the price you originally paid for them. For example, you buy a share of Apple at $150. If tomorrow the market says that same share is worth $140, the accounting system marks that you have $140, not $150. It may sound like just a technical detail, but it changes everything. Because in practice, it forces you to live inside the emotions of the market in real time. It forces you to face gains or losses immediately, even if you haven't sold a single share. Now here's the interesting part. This practice is a double-edged sword. For some, it creates panic. For others, it creates doors that lead to incredible opportunities. During the 2008 financial crisis, banks and funds were forced to apply mark-to-market to their balance sheets. The result was devastating. Assets that were healthy in the long run were marked down to nearly worthless levels, simply because the market was panicking. That triggered a chain reaction. Reports showing massive losses, investors running for the exits, funds liquidating positions, and the entire market collapsing. All because today's price was treated as the only truth. But while the crowds panicked, the biggest investors saw something else. They realized that many of these markdowns had nothing to do with the real value of the assets. And guess what? They bought. They bought cheap. And years later, they reaped extraordinary returns. So, what does this mean for you, the smart investor? It means that every time the market is forced to mark assets lower, a hidden map of opportunities is created. A corporate bond might be marked at 70% of its value because of panic. But if the company is still solid, still paying interest, still generating cash, then the risk is not real. It's just the reflection of temporary fear. For the long-term investor, that is gold. It is literally like walking into a store where high-quality assets are being sold at a discount. Picture this. A corporate bond originally worth $1,000 is revalued by the market at $850. That's the mark-to-market adjustment. But you look deeper. You see that the company is still healthy, that it continues to pay its interest, and that at maturity the bond will be worth the full $1,000 again. If you buy at $850, you lock in higher returns, and you also profit when it comes back to par. What looked like a painful loss to others becomes a winning ticket for you. And if you are enjoying this way of seeing the market behind the curtains, take a second right now and subscribe to Investor School. Every week I share insights like this that can completely change the way you approach investing. Don't miss what's coming next. Now, don't think this only applies to bonds. Stocks also get heavily affected by mark-to-market, especially during reporting seasons. Investment funds are required to register their positions at current prices. That means that when markets are volatile, many funds are forced to sell positions just to avoid showing massive losses on their reports. And here's what happens. That forced selling pushes prices down further, often way below what the company is truly worth. This opens up a window for investors who are paying attention. Have you ever noticed how sometimes a stock falls brutally and then bounces back just weeks later? Very often, those drops had more to do with mark-to-market accounting than with real company problems. Big players like hedge funds and institutional investors watch these moments like hawks. They know that forced selling equals opportunity. They ask themselves, is this drop the result of a real structural problem with the company? Or is it just the market reacting to an accounting rule? When the answer is, it's just accounting, they buy aggressively. And that's one of the secrets that separates amateurs from professionals. It's not only about analyzing the asset itself, but also about understanding how the rules force the market to behave. And here's the deeper layer. Mark-to-market isn't only about prices. It's about collective psychology. It amplifies emotions. It makes losses look bigger and gains look shinier. It forces people to react irrationally. But if you have discipline, patience, and knowledge, you can use that irrationality to your advantage. While most people panic, you can stay calm and see the logic hidden beneath the chaos. So here's the big insight. Mark-to-market might look like a cold accounting rule, but in reality, it is a window into the market's emotions, fear and greed. If you can learn to spot when those emotions are exaggerated, you have found one of the most powerful tools to invest wisely. Next time you open your portfolio and see everything in red, don't panic. Ask yourself, is this a real loss? Or is this an opportunity that mark-to-market is handing me on a silver platter? Remember, the greatest investors in history built fortunes by buying when everyone else was selling. They understood that the market price at that moment was not the real value. That's the mindset that turns good investors into legends. If you enjoyed this video, give it a like, share it with someone who needs this perspective, and of course, subscribe to the channel. Here we turn market complexity into clarity, so you can invest smarter.